Hello guys, are you okay? I hope you are all doing well. In our previous chapter 5, we discussed the monetary policy and the monetary transmission mechanism. We examined that how monetary policy works through different channels, Keynesian and monetarist view, empirical evidence on monetary transmission, the role of monetary policy during inflation and depression, and finally, the constraint to the effectiveness of monetary policy, especially in developing countries. That discussion helps us understand why monetary policy does not work the same way in all countries. Today's portion also, chapter 6. This is also final chapter. Today we are starting this chapter 6, monetary policy in less developing country and in Ethiopia. In this chapter we will move from theory to really world application, focusing on developing country in general and Ethiopia in particular. Especially we will focus on three main sections. 6.0, conduct of monetary policy in less developing country. How monetary policy is implemented in less developed country, the challenge they face compared to developed economy. 6.1, power and function of the National Bank of Ethiopia. The legal authority of National Bank of Ethiopia, it is major role and responsibility in the Ethiopian economy. And the 6.2, conduct of monetary policy in Ethiopia. The actually tools and practice used by the National Bank of Ethiopia. How monetary policies applied in the Ethiopian context. By the end of this chapter, you will clearly understand how monetary policy operate in developing economy and in Ethiopia, and how theory connect with practice. So please don't forget subscribe, like and share. Now let's begin with section 6.0, conduct of monetary policy in less developed country. The conduct of monetary policy in less developed country. My dear student, now let's clearly understand how monetary policy is conducted in less developed country and why it differs from developed economy. Broadly speaking, monetary policy in less developing country has been used to fulfill the following objectives: exchange rate stability, price stability, full employment, economic growth, stabilization of income, and neutrality of money. That means, broadly speaking, monetary policy in less developed country is used to achieve the following objectives. These are exchange rate stability, price stability, full employment, economic growth, stabilization of income, and neutrality of money. However, in developing country, economic growth and capital formation receive especially emphasis. Monetary authority do not influence directly the policy variable or finally target, namely growth, employment, and price. However, policy authority use the intermediate target to achieve those finally target by using three instruments, namely money supply, credit availability, and interest rate. That means it is important to understand that monetary authority do not directly control the final target such as economic growth, employment, and price level. Instead, they influence the final target indirectly through intermediate target, namely money supply, credit availability, and rate of interest. These intermediate targets are controlled using monetary policy instruments. The chief objective of monetary policy in developing economy should be raise the rate of capital formation and economic growth. This can be done by adopting expansionary monetary policy to stimulate investment by lowering the rate of interest, undertaking public investment on large scale, directing investment into desired channels through selective credit control. That means The main objective of monetary policy in less developing countries is to raise the rate of capital formation and accelerate economic growth. This is mainly achieved through an expansionary monetary policy, which includes lowering the rate of interest to stimulate private investment, undertaking public investment on a large scale, especially in infrastructure, directing investment into desired sectors through selective credit control. A mere dose of inflation or less than 10% helps in raising the level of investment. But if the inflationary pressure continues mounting up, monetary authority could use both direct and indirect method of credit control of the indirect instrument. When monetary transmission mechanism in less developing country, when the role of inflation, a moderate level of inflation or less than 10% can help raise investment by increasing profit expectation. However, if inflationary pressure continues to rise, it becomes harmful. In such case, the monetary authority use both direct and indirect credit to control this. When we see open market operation or OMO, it cannot be of much help because centrally bank do not have a complete control over commercial bank. That means OMO is less effective in less developed country because the central bank does not have full control over commercial bank. The bill market is generally small and underdeveloped. Commercial banks are not encouraged to invest in government security or low interest rate, but prefer to keep their reserve in liquid form. So totally, almost less effective in less developed country. The central bank does not have full control over commercial bank. The bill and bond market are small and underdeveloped. Commercial bank prefer to keep liquid reserves rather than investing in low interest government security. And the other one also, discount rate policy can also not be effective because commercial banks have the habit of holding large cash reserve and do not borrow from national bank. Large NBFI or large non-bank financial institutions are outside the control of national bank. That means discount rate policy is also weak in less developed country because commercial banks usually hold large cash reserve and do not depend on borrowing from the central bank. Non-bank financial institutions operate outside the control of the central bank. Therefore, it is believed that the use of recurred reservation can be more helpful than the bank rate policy and open market operation. Moreover, in developing economy, people generally tend to invest in gold, silver, real estate, and it is instead of investing their money in productive channel. Therefore, selective credit control measures are more suitable for controlling and limiting credit facility for speculative and unproductive activities. That means because direct instruments are weak, less developed country really more on the first one, recurred reserve ratio and selective credit control. So, recurred reserve ratio, it is more effective than OMO and bank rate policy. It directly affects the lending capacity of commercial banks. And selective credit control also, these are very important in developing economy because people often invest in gold, silver, real estate, and speculative active. Credit must be restricted for unproductive purpose. Credit should be directed toward priority sectors such as agriculture, industry, and infrastructure. High interest rate will also attract the inflow of foreign funds and help in reducing the balance of payment problem. The policy of high interest rate could induce people to save more, develop banking gap among people, speed up capital formation and economic growth. Empirically studied have provided that in developing economy, investment is interest inelastic because interest is just a small fraction of the total investment cost. That means when we see interest rate policy in less developed country, high interest rate can attract foreign capital inflows, help reduce balance of payment problem, encourage saving, promote banking gaps, speed up capital formation and economic growth. However, empirical studies have shown that investment in less developed country is interest rate inelastic. This is because interest cost is only a small part of total investment cost. Other factors like infrastructure, technology, and political stability matter more. Okay. Generally, monetary policy in developing countries is not successful in meeting its objective because of the following limitation: unorganized money and capital market, like a large monetized sector, large number of non-bank financial institutions outside of the control of the central bank, large hoarding in the form of jewelry, gold, real estate, and its existence of foreign banking. So totally, what does mean it? Why monetary policy is generally less successful in less developed country? Monetary policy often fails to achieve its objective due to the following limitation: because unorganized money and capital markets, large non-monetized sector, many non-bank financial institutions outside the central bank of control, high cash reserve held by commercial bank, large hoarding of wealth in gold, jewelry, and real estate, presence of foreign bank with limited domestic policy influence. In conclusion, monetary policy in less developed countries plays supportive but limited role. Due to structural weaknesses, monetary policy alone cannot ensure growth and stability. Therefore, economists strongly recommend using monetary policy together with fiscal policy. So, this all are about the conduct of monetary policy in less developed country. Now let's move to 6.1: History and importance of the National Bank of Ethiopia. In this section, we are going to understand the historical background and importance of the National Bank of Ethiopia, which is the central bank of our country. Now this history helps us understand how monetary policy involved in Ethiopia. The National Bank of Ethiopia was established in 1963 by Proclamation 206 of 1963 and began operation in January 1964. So, establishment of National Bank of Ethiopia. The National Bank of Ethiopia was established in 1963 by Proclamation number 206 of 1963. Although the proclamation was issued in 1963, the bank began its actual operation in January 1964. This proclamation was part of Ethiopia Monetary Bank and the Banking Law of 1963, which brought a major reform to the Ethiopian financial system. Proclamation 206 from the Ethiopian Monetary and Banking Law in 1963 switched things up by separating the function of commercial and central banks in Ethiopia. This leads to the split of the Bank of Ethiopia into two branches: the National Bank of Ethiopia and the Commercial Bank of Ethiopia. The National Bank of Ethiopia became the official central bank of Ethiopia, and its power increased after the Ethiopian government enacted socialist policy in the Ethiopia 1974. So, the separation of central and commercial banking function. Before 1963, Ethiopia had single institution known as Bank of Ethiopia. This bank performed both central bank and commercial bank function, which is inefficient and risk. After Proclamation 206 of 1963, the law clearly separated the function of central bank and commercial banking. As a result, the Bank of Ethiopia was split into two institutions: the National Bank of Ethiopia, responsible for central banking, and the Commercial Bank of Ethiopia, responsible for commercial banking activities. This separation was crucial step toward building modern monetary and financial system of Ethiopia. In 1991, after the EPRDF ended socialist policy in Ethiopia and enacted liberal economic system, the Monetary and Banking Proclamation of 1994 established the National Bank of Ethiopia as judiciary entity separate from the government. The Monetary and Banking Proclamation of 1994 also outlined the role, function, and expected duty of the National Bank of Ethiopia. What does it mean? Let me tell you detail. When we see role of National Bank during the socialist period or 1974 up to 1991, in 1974, Ethiopia adopted socialist economic system. During this period, the role and power of the National Bank of Ethiopia expanded. The financial system became highly centralized. Credit allocation and interest rate were administratively controlled. The National Bank of Ethiopia mainly served as an instrument of government rather than an independent monetary authority. And reform after 1991 or liberalization era, in 1991, the EPRDF government ended the socialist system and introduced liberal economic policy. As part of this reform, a new monetary and banking proclamation was issued in 1994. This proclamation was very important because the re-establishment the National Bank of Ethiopia as legal or judiciary entity. It made the National Bank of Ethiopia institutionally separate from the government. It aimed to improve professionalism, accountability, and effectiveness in monetary management. So, what's the importance of the 1994 Monetary and Banking Proclamation? The 1994 proclamation clearly defined the roles and function of the National Bank of Ethiopia, specified the power and responsibility of the National Bank of Ethiopia, strengthened the institutional framework for conducting monetary policy, helped Ethiopia move toward market-oriented financial system. Okay, why the National Bank of Ethiopia is important? Because in summary, the National Bank of Ethiopia is important because it serves as officially central bank of Ethiopia. It oversees the monetary and banking system. It plays key role in price stability, financial stability, and economic growth. It acts as the foundation for effective monetary policy transmission in Ethiopia. So, to conclude, the establishment and evolution of the National Bank of Ethiopia reflect Ethiopia's broader economic transformation from centralized system to more liberal and market-oriented economy. Understanding this history prepares us well for the next section, where we will discuss the power and function of the National Bank of Ethiopia in detail. So, dear student, after understanding the history and importance of the National Bank of Ethiopia, we now move to its power and function, which explain what the National Bank of Ethiopia is legally allowed and expected to do. 6.1.1 Powers and function of the National Bank of Ethiopia. In 1991, Proclamation 83 outlined the function of the National Bank of Ethiopia. The National Bank of Ethiopia was tasked with printing currency and controlling the country money supply, or managing the international reserve of the country, creating and managing the country exchange rate policy, licensing, supervising, and regulating commercial bank, insurance company, and other financial institutions. providing short and long-term refinancing facilities to banks and other financial institutions, promoting financial inclusion in Ethiopia, acting as banker, fiscal agent, and financial advisor to the government. What does it mean? That means the legal basis of National Bank of Ethiopia's powers in 1994, Proclamation number 83 in 1994 clearly outlined the power and function of the National Bank of Ethiopia. This proclamation strengthened the National Bank of Ethiopia authority to conduct monetary policy, regulate the financial system, and support economic stability. So, major power and function of the National Bank of Ethiopia. Let's discuss the main function one by one. The first one is issuance of currency and control of money supply. The National Bank of Ethiopia has the exclusive power to print and issue currency or notes and coins in Ethiopia. It also controls the country money supply using monetary policy instrument. This function is essential for price stability and inflation control. The second one is also management of international reserve. The National Bank of Ethiopia is responsible for managing Ethiopia international reserves such as foreign currency, gold, IMF reserve positions. These reserves are important for maintaining external stability, supporting the exchange rate, financing the balance of payment needs. The third one is also formulation and management of exchange rate policy. The National Bank of Ethiopia design and implement the exchange rate policy of the country. It intervenes in the foreign exchange market to reduce excessive fluctuation, maintain competitiveness of export. Exchange rate stability is crucial for trade, investment, and macroeconomic stability. And the fourth one is licensing, supervision, and regulation of financial institutions. The National Bank of Ethiopia licenses and supervises commercial bank, insurance company, microfinance institution, and other financial intermediaries. This ensures financial system stability, protection of depositors, sound and healthy banking practice. And the fifth one is lender of last resort and refinancing facilities. The National Bank of Ethiopia provides short-term and long-term refinancing facilities to bank and financial institutions. This function helps solve temporary liquidity problem, prevent bank failure, maintain confidence in the financial system. And the sixth one is promotion of financial inclusion. The National Bank of Ethiopia works to expand access to financial service, especially for rural population, small business, low-income household. Financial inclusion supports also saving mobilization, investment, and inclusive economic growth. And the seventh one is also banker, fiscal agent, and financial advisor to the government. The National Bank of Ethiopia acts as banker to the government or holds government account, fiscal agent or manage public debt and treasury operation, and financial advisor on monetary and financial matters. This role helps coordinate monetary and fiscal policy. Okay, when we see also overall importance of this function, together this power enable the National Bank of Ethiopia to maintain price and financial stability, ensure a sound banking system, support economic growth and development, strengthen the effectiveness of monetary policy transmission. In conclusion, Proclamation number 83 of 1994 gave the National Bank of Ethiopia a strong legal foundation to act as an effective central bank. Okay, Okay, now so let's see the main difference between National Bank of Ethiopia and Commercial Bank of Ethiopia. Table 6.1, the main difference between National Bank of Ethiopia and Commercial Bank of Ethiopia. Dear student, this table helps us clearly distinguish between the Central Bank and Commercial Bank in Ethiopia by comparing the National Bank of Ethiopia and Commercial Bank of Ethiopia. When we see difference in loan activity between them, National Bank of Ethiopia grants the loan mainly to the government and other bank. It acts as lender of last resort. It does not lend directly to the general public, but Commercial Bank of Ethiopia also grant to the individual business firm and organization. Its objective is to support commercial activities and investment. Key idea: National Bank of Ethiopia lends to banks and government, while Commercial Bank of Ethiopia lends to the public. When we see difference in purpose, National Bank of Ethiopia primarily serves the government and financial system as whole, focuses on macroeconomic stability, not on profit. But Commercial Bank of Ethiopia is also primarily serve as individual and business, operate with the object of profit making. Key idea: National Bank of Ethiopia serves the economy. Commercial Bank of Ethiopia serves the customer. And when we see difference in function, National Bank of Ethiopia, the only central bank in Ethiopia, responsible for monetary policy, currency issue, and regulation. But Commercial Bank of Ethiopia, more than 80 operating in Ethiopia. I think today it is more than 32. I think so. So it is not one, and it performs commercial banking function like deposits and loans. So key idea: National Bank of Ethiopia is monopoly central bank, while Commercial Bank is one among many commercial banks. In conclusion, the National Bank of Ethiopia focuses on economic stability and policy, whereas the Commercial Bank of Ethiopia focuses on commercial and profit-oriented activities. Understanding this distinction is essential for monetary policy, banking exam, and real-world financial knowledge. Okay, now let's move to 6.2, Conduct of Monetary Policy in Ethiopia. 6.2.1, Object of the Monetary Policy of the National Bank of Ethiopia. Having discussed the power and function of the National Bank of Ethiopia, we now turn to how monetary policy is actually conducted in Ethiopia. This section explains what the National Bank of Ethiopia aims to achieve and which instrument it uses to implement monetary policy. National Bank of Ethiopia uses various policy instruments in its monetary policy implementation. The two most important tools are open market operations, or sales and purchase of bonds or security or issued by the government, standing central bank credit facility. So, in object of the monetary policy of the National Bank of Ethiopia, the National Bank of Ethiopia implements monetary policy to achieve macroeconomic stability, especially price stability, financial system, and sustainable economic growth. To achieve this objective, the National Bank of Ethiopia uses various monetary policy instruments to influence money supply, credit condition, and interest rate. The other monetary policy instruments used and to be used include reserve requirement, setting of floor deposit interest rate or until interest rate is fully deregulated, direct borrowing or lending in the interbank money market, and introducing repurchase agreement or repo reverse or repo operations. Use of the selected credit control when necessary and morally sane. This means an objective of the monetary policy of the National Bank of Ethiopia, the National Bank of Ethiopia implement monetary policy to achieve macroeconomic stability, especially price stability, financial system stability, and sustainable economic growth. To achieve this objective, the National Bank of Ethiopia uses various monetary policy instruments to influence money supply, credit condition, interest rate. So, major monetary policy instruments used by the National Bank of Ethiopia. Among the many tools available, two instruments are the most important. They are open market operation is the first one. Open market operation involve the sale and purchase of the government bond or security by the National Bank of Ethiopia. When the National Bank of Ethiopia sells security, money is withdrawn from the economy. Then money supply will decrease. Buys security, the money is injected into the economy. Then money supply will increase. OMO is used to control liquidity in the banking system, manage inflationary and deflationary pressure. Then when we see the second one is standing central bank credit facility. This facility allows commercial bank to borrow from or deposit funds with the National Bank of Ethiopia on a short-term basis. It helps manage short-term liquidity problem of bank, establish the interbank money market. Interest rate on this facility act as a signal to the market. Other monetary policy instruments used by the National Bank of Ethiopia in addition to the two main tools. The National Bank also uses or plans to use the following instrument. The third one is also reserve requirement. The National Bank of Ethiopia sets the minimum reserve that bank must hold, increase reserve requirement, reduce bank lending capacity, decreasing reserve requirement, like expand security availability. The fourth one is floor deposit interest rate. Until interest rates are fully deregulated, the National Bank of Ethiopia sets minimum deposit interest rate. This helps encourage saving, protect depositor, improve monetary transmission. The fifth one is also interbank money market operation and repo agreement. The National Bank of Ethiopia participates in the interbank money market by borrowing and lending directly, introducing repurchase agreement or repo and reverse repo operation. These tools help manage short-term liquidity and guide interest rate. The sixth one is selective credit control. When necessary, the National Bank of Ethiopia may use selective credit control to direct credit toward priority sectors and limit credit to speculative or non-productive activities. The seventh one is moralization. Moralization involves persuasion rather than force. The National Bank of Ethiopia uses discussion, guideline, and recommendation to influence bank behavior and encourage compliance with policy objectives. So, in summary, the National Bank of Ethiopia conducts monetary policy using both market-based and administrative instruments. While open market operation and standing facilities are the core tools, other instruments support liquidity management and financial stability. The gradual shift toward market-oriented instrument reflects Ethiopia's financial sector development. In conclusion, the conduct of monetary policy in Ethiopia shows a transition from direct control to modern monetary instruments, guided by the objectives of price stability and sustainable growth. This completes Chapter 6 and full monetary economics course. Conclusion of this Chapter 6. Alright, my dear student, with this section we have now successfully completed Chapter 6, which is also final chapter of this unit of monetary policy. In this chapter we clearly discussed the conduct of monetary policy in developing country, the history, power and function of the National Bank of Ethiopia, the difference between National Bank and commercial banks, and finally how monetary policy is conducted in Ethiopia including the major instruments used by the National Bank of Ethiopia. This chapter helped us connect monetary policy theory with really practice in Ethiopia, which is very important both for exam and really life economic understanding. So my dear students, I am happy to tell you that we have now finished the full course in this discussion. All the chapter, concept and important topic are fully completed. In our next session, I will start bringing you exit exam oriented questions, especially important and frequently tested questions from monetary economics and other related in economics courses. I also want your participation. Please comment below and tell me which course or topic you want me to bring next. Your comment will help me decide the next content for this channel. If this lesson helped you, like the video, subscribe to the channel, share it with your classmates and friends. This is really support the channel and helps more students learn. Thank you very much for learning with me, and I will see you in the next video with exit exam question. Have a nice time. Bye.